would represent 10 US dollars per 100,000. So if you took a position at 128.75 in 100,000 euros against the US and you bought it, each time that changed, for example, to 128.76 per 100,000, that would make you 10 US dollars. If it dropped to 128.74, you would lose 10 US dollars per 100,000. So for $1 million, for $1 million euros, that would represent per pip 100 US dollars. You can see therefore that the pips are relevant in deciding what your exposure is going to be, or your face value risk. Obviously 100,000 would cost you $1,000 at 1%, and you could trade at 10-point pips. Remembering that these currencies can move, particularly in volatile times, anything up to 200 or 300 pips per day, so there is plenty of opportunity for you to make money, as long as you're aware that if it goes against you, then that you will be also losing at that rate as well. Using orders intelligently, this is going to differ with all of you. You're all going to have a different way of trading. We'll be covering some of these in greater detail when we're discussing trading plans this afternoon at 2 o'clock, and you're obviously all welcome to attend that if you wish. Generally what you need to do though is you need to work out what orders are best for you. It may be that the limit order situation is a better thing for you, where you buy at a predetermined price above, or if you're selling below if you're buying, and above if you're selling, looking to go short above the market. It may be that you have more of a day trader mentality, very, very short term, and you use market orders. You may use trailing stops, for example, rather than just fixed stops to take advantage of price movements, particularly when you get deep into the money, and if the market corrects, it takes you out automatically. Okay, you really need to work this out to suit your style of trading and the way you want to achieve the desired results which you source. Other orders we've sort of covered. We won't go into these in great detail, but they're all available to you. A limit is buying below the current market level and selling above the current market level if you want to go short. Stop orders need to be determined as a risk management tool. They're a very, very important part, particularly in volatile markets, and how you place those and do those. Stop if bid and stop if offered is a variation of stop that we offer you, and some of those will suit you and some of those won't. One cancels the other are an order type that we offer to you, where you can purchase below the market if the market was to pull back, for example, from a current level, or alternatively if the market was to break higher and you wanted to get on board that market, then you could buy there and the other order would cancel. They're simultaneous entry orders, which may suit you, again they may not. If done is when you're entering a position as a limit or as a stop entry, or going to the market to just purchase, for example, you can then place your exit strategies prior to you actually entering that position. We encourage you to use these so that you can basically set and forget if that's what you want to do. The day traders tend not to use these because they are sitting at their screens. It's something you need to consider, and again we'll cover this in more detail on these order types and how they can be adopted in the session this afternoon at 2 o'clock. What we're going to do now is just turn off the audio for a moment, and we'll bring up the mini trader platform and try and put some of this in more context and give you an idea of other things that you need to be aware of, such as fundamental and technical issues associated with currency trading, and those sorts of things. We'll show you where you can find them, etc., etc. So just bear with us one moment. Okay. For those of you that have been on the Big Trader, which offers all our asset classes, you'll note that this is very much the same look and feel as that platform, and you'll see that we're in simulation mode here. So you all have access to this if you want. The major difference with this platform, being the Get Mini Trader, to the big platform, is that you have a limited access to currency pairs. There is no CFDs except for index trading CFDs. For example, CFD on the ASX 200 as a CFD, or other exchanges. So we limit you in here, but the whole, as into the availability of assets, the whole reason for this is mainly for the currency traders who are new to the market to be able to trade in a real environment and minimize their risk by trading in smaller amounts without attracting the fees that are associated in the bigger platform. For example, in the Australian dollar against the US dollar pair, if you are trading that on the big platform and you trade in an amount, face value amount of under $100,000, we will charge you an $11 ticket fee. That means that if you trade in 30,000 Australian dollars against the US, you will incur an $11 ticket fee. If you trade in $90,000 against the US, you will incur an $11 ticket fee, but if you trade in $101,000 against the US on the big platform, you won't incur any fees. In this platform, you can trade as low as $5,000 and not incur any ticket fees, and the reason we do it is because there was a demand, and I believe still is a demand out there, that people want to trade in the real market but be able to not attract ticket fees by trading in smaller amounts, and this is the tool that allows you to do that. However, we do limit, and you can see there that there's a much smaller amount of currency pairs, and you will find that they're basically all major currency pairs, because if you want to limit your risk, then we are not going to offer you minor or exotic currencies, which will obviously increase your risk. So what you would need to do is, if this is a product that is appealing to you, then you can come in here, choose which currency pairs and all the major crosses, and